G'day there, Wealth Press traders, viewers, investors, and subscribers. It's time for another weekly wrap-up, and I'm joined, as usual, by Mr. Roger Scott. Roger, welcome.
Thank you for having me on, James.
Roger, great to have you as usual. Roger, it's a very peculiar week in the market. The 10-year interest rate is pushing higher. I saw it at 1.61 this morning. The price of gold has fallen right out of bed. It's down below $1,700, lower. Last time it was at this level was coincidentally March of 2020. Silver has followed suit, yet other commodities like lumber is still pushing higher, but even copper is backed off a bit. Is this all a result of the imminent passing of the $1.9 trillion relief package that Joe Biden is pushing through?
I think it's a combination of three things. If you want me to be very accurate, I think it's three things. It's definitely part stimulus. It's definitely part stimulus. There's no question about that. But it's also part sentiment. Market sentiment is changing. There's a lot of hedge funds repositioning their portfolios. Markets are taking on a different tone right now. We are clearly starting to favor the going out stocks versus the staying at home stocks. I don't want to label them as COVID stocks because that's just not fair. But the market is doing a complete 180, and it's impossible to think that. Think about this. Think about how much money is involved in the market. Think about all the billions and trillions of dollars that are being pumped in and out every day. It would be hooviest to us to think that there would be no volatility in seeing this happening, but it's just impossible. I mean, look, Clorox was the number one stock 10 months ago in the S&P. Now Clorox is the bottom of the barrel. It's like 497 spot. And Norwegian Cruise Line and Carnival were literally at the bottom of, sinking to the bottom of the ocean, excuse the pun. And now they're rising to the top. They're in the top 10th percentile. I was just looking at it a few minutes ago. Energy stocks that were sinking, Marathon, all of the energy stocks are now going up. Financial stocks are moving up. We are seeing a complete reversal and a complete change of where we were in the dynamics of the market less than 6 months ago, James. And it's just so many things happening at the same time. You've got the world starting to look at what the world will look like after COVID. That's as clear as day. The market has spoken, and we can never argue with what the market says. At the same time, you have inflationary pressure in specific commodities and specific assets. And at the same time, you've got the government pumping money, giving people another check, which is a lot of it is going to go back into the market. And at the same time, interest rates, while they are going to go higher, they're still near historic lows. And I'm going to tell you something, James, and you're going to appreciate this. I did some this is something you're going to like hearing. This is old school economics, okay? There's been a lot of talk. Especially last 10 days about the impact of interest rates on the stock market. Would you agree?
Absolutely. It's been all the buzz.
All the buzz, exactly. Speaking of which, David Portnoy's new ETF that came out, the ticker symbol is BUZZ, B-U-Z-Z. Just FYI, you mentioned all the buzz. That started trading yesterday. For anybody out there who may want to take a look at it, that's live now, B-U-Z-Z, BUZZ. Thanks for bringing it up. Indirectly, of course. But seriously, let's talk about this. Let me dispel all this interest rate mumbo jumbo for you, okay? Interest rates are, as you mentioned this morning, 10-year interest rate yield is about 1.6%. Yeah. 1.5, somewhere in that ballpark, right?
Well,
somewhere in that
1.57 as we speak.
Well, there you have it. At the end of the year, all the economists' consensus is they're going to go to 2.5%. All right? 2.5%. Does that sound reasonable to you? Not too bad, not too inflationary, but let's say they go to 2.5%. Okay? I've looked back, going back about 50 years, and there is about a 100 basis point differentiation or a premium between the 10-year and the broader market, the S&P 500. Now, what I did was I looked at the trailing 12-month EPS on earnings per share yield on the S&P 500 at the end of 2021. All right. And I extrapolated the expected earnings per share on the S&P 500 earnings per share. And you know what it is, James? It's at about 4 to 4.5% yield. So guess what? That puts the stock market's price right now with the expectation of where it's going to be at the end of the year, expecting interest rates to be about 2.5 to 3%. It's priced into the stock market, folks. Nobody's talking about that, though. It's amazing. Go back 50 years and look at the interest yield on the 10-year, and then look at the interest yield on the S&P 500. The S&P is always about a point and a half above. And that makes sense. There's more risk in stocks than bonds. So you've got to have a little more yield, right? But it's always a point to a point and a half. I'm telling you, James, go back to 1975. You will see it's always a point to a point and a half higher. I wouldn't be talking unless I did my due diligence here. Sure, and I looked at it, and I looked at the trailing EPS on the S&P 500. I divided it by the expectation of the price at the end of 2021 based on the current 12-month trailing, which is what the economists all expect it to be. And it's pricing in about 1.5% above a 2.5% yield on the bond market. So what's this big fuss all about? It's already priced into the market, where the market is where the market was a week ago, let's just say. Big deal. It's already folks, we're already pricing in interest rates to be on the 10-year at 2.5%, and the yield on the EPS for the full year on the S&P 500 to be at about 3.5 to 4%, which is exactly 1 to 1.5% higher than the 10-year. Priced into the market, you have nothing to fear. It's business as usual. And I'll tell you another thing that's causing me to think that this is just a very mild correction and nothing crazy with interest rates. The fact that whenever you have a real bearish move in the stock market, it tends to not be sector specific. It tends to be very broad. And this correction we're seeing, it's really focused mostly in the large cap tech. Now, there's a lot of large cap tech in the S&P 500, and it'll trickle into the Dow, and it'll trickle. But if you look at the Russell 2000, it's still trading above the 50-day moving average, while the Nasdaq 100 is halfway between the 50-day moving average and the 200-day moving average, which is what I call the twilight zone. So it's very specific. I think it's already getting a little overblown, but as I've said to you over the last 3 months, every time we spoke, momentum levels on the Nasdaq are stretched out to the tilt, and they're at an 11-year high, and we need to cool off. So here's what my analysis is. This is more to do with not interest rates, but the fact that momentum levels in the large cap tech stocks just got way over their hands. The current interest rates, while yes, we are going to see some inflation, just as we've seen over the past year, and you and I have been talking about it since last March, April, and May, when you couldn't find the lumber cheap enough to do the deck. Remember that conversation we had? Yeah. Nothing has changed. Nothing has changed.
The price of lumber has doubled again since then.
No. What I mean is nothing. No, what I'm saying is we saw inflation then. We're seeing it now. But what I'm saying is it's not. What I mean is the environment has not changed much. It's gotten worse, but it hasn't really changed. We saw inflation. We're seeing worse inflation, but we're seeing it in a very kind of sort of narrowish area. We're not seeing it across the board like we're usually seeing it. And yeah, I think we are going to see some inflationary pressure. I think that's a given. But at the same time, interest rates are still really low, and it's going to take a while for things to really heat up. But I guess I took the long way to answer your question. But I think this is a matter of three things: market repositioning itself, the stimulus, and interest rates. It's a combination of these three things that are taking place, and that's what's causing the market to get a little bit out of whack, if you will.
Yeah. Okay, Roger. Well, so take a look at this. This is the gold chart here, and this little period right in here is where we saw the market crash. This is where the the market crashed, the S&P 500 crashed, everything crashed, and gold crashed ahead of that as well. And that resulted in the stimulus, which actually occurred more in here. And that was the catalyst for gold to start this much bigger uptrend that culminated with an all-time record just below 2,100. So it seems to me that among the indications flashing is that, yes, inflation is a direct result of monetary inflation, which is not something that we have to debate about. There's no debating the fact that the monetary inflation, the global money supply, has increased exponentially. And so I was doing an interesting exercise. And did you know that the price of lumber per 1,000 board feet from 1974 to 2004 went from $110 to about $220. So it took 40 years to double. And then from 2002 to 2010, it doubled again. And from 2002 to 2021, or 2010 to 2021, it is now tripled. And the price has gone vertical. And so runaway inflation and hyperinflation are, in my view, what we are in the early stages of here. And so I'm curious as to, looking at gold way down here at 1690, just ahead of another $1.9 trillion in stimulus, does that not portend that there is going to potentially be a great opportunity there, and possibly much worse than a great opportunity? It's going to be the only game in town if we're not careful.
Well, okay, well, that's a great question. Let me answer your question. As you remember, and I've mentioned this when gold was going up several weeks ago, when it was moving higher, or several months ago when it was moving higher, we saw some analysis, very interesting analysis, and the analysis showed us that gold doesn't rally very often. It rallies once every 10 to 12 years, but when it does rally, it tends to really move. It's not a bellwether kind of an asset. It's more of a fundamental. Fundamentals drive gold, not really technicals. Even though a lot of traders would argue with that. I think gold is still one of those assets that has a really strong supply demand driving the market versus commodities such as corn, wheat, and so forth. But with that said, I think there's still a strong opportunity for gold to rise and for silver to rise as well. I think that, and as I mentioned this over and over again, this COVID-19 is setting off a chain of events that's still, right now to this day, it's been a year now, roughly a year, it's still driving this market. The market is still being driven by events that began there. That was the catalyst that's driving this market. And I believe that over the next several years, that'll continue to be the case. We will look back and we will say this is all a COVID driven. This all started because of COVID. The stimulus right now is because of COVID. But I don't know if gold will be the only game in town. But yes, I am seeing potential for much, much higher gold prices. Absolutely. But see, James, I don't think it's going to happen quickly. I think it may happen over the next year and a half to 2 years. I think we may have to have. I think the party in the stock market with the stimulus coming in and with interest rates still low, I think we're going to see gold remain inflated, but I think there's potential for a lot more upside than this. In terms of it being the only game in town, maybe a bit too premature for that, but I wouldn't rule it out. Not at all. But definitely something really devastating would have to happen for that. And I'm not there yet. Not at all. Especially with seeing a bunch of sectors making new highs. Transport's making all-time highs just the other day. I'm seeing a lot of the energy stocks, MRO, really, Marathon, a lot of really good energy stocks. I'm seeing the cruise ships coming up. It feels a lot more like a redistribution of wealth within the stock market than a runaway train outside of the stock market, especially in light of what the bond market's doing.
Interesting.
but I like your point of view, and I see where you're going, and I think and I'm not throwing it out with the bathwater. I'm just saying that it may take a little longer than some people who are bullish on gold realize, in my opinion. But I would not throw that out, not at all. I think it's very viable.
Mm-hmm. Yeah, well, so that's, for me, that's the, the intriguing focal point for this very volatile market. I mean, the VIX is up 27.9 now, which is sort of heading into the red part of the meter.
Yeah.
You've got this crazy disconnect between the commodities and the interest rates and the stock market, where they're all very frothy, generally over the longer term, but they are all showing signs of short-term enhanced volatility. So, Nasdaq 100's been up and down in the last week. The Dow's been up and down in the last week. The S&P 500 up and down. And, and now gold way down here, just ahead of stimulus. The thing for me is none of this makes sense if the general atmosphere is conducive to risk-on behavior. And so, to me, I'm always looking for, they call it a black swan, but I always found that term misleading, because ahead of the financial crisis, there was no number of non-mainstream financial commentators pointing out the fact that we were beyond the red zone on the danger meter, thanks to the securitized debt issue. And so a black swan is only a black swan if you don't know about black swans. If you know about black swans and you know what constitutes a financial, geopolitical, macroeconomic black swan, then you're always on the lookout for black swans in your pond. And so, here we are going into 2021. Money supply is at an all-time high. Interest rates globally are at unprecedented historic lows. Commodities are at all-time highs. We've got a new monetary class we call cryptocurrencies that is the very epitome of speculative asset class with no intrinsic value, if you ask some people.
You know what Munger, Charles Munger, called cryptos last week, right?
I didn't hear, no.
He called it the annual Warren Buffett's annual meeting. He literally, and I mean it, he literally used the word turds to describe cryptos. This is a 91-year-old man, who's running the 8th largest fund in the world. But I just thought it was interesting since you mentioned that. But yeah, I'm sorry, I didn't mean to interrupt your train of thought. But yeah, no, there's a lot of things going on, James. There's a lot of things going on. It's a very dramatic movie, if you will. It's a very dramatic movie. It's got a lot of moving parts. This economy, what it's setting up for, can make a very interesting economics exam. Let's just say that. But again, at the same time, look at this. Gold has had some correlation with the overall stock market, and the overall stock market, as of right now, is still expected to rise 14 to 16% according to Goldman Sachs next year. Earnings are expected to be positive. Tech actually has real numbers behind it. And again, you have the stimulus, which a lot of this cash that's coming in is going to go right back into the stock market. And consumer sentiment is picking up. So, and real estate in America and in Canada, by the way, well, at least when I was there a couple of years back, residential real estate can't be built fast enough here. So it's a mixed bag. But to your point of gold moving higher from these levels, I wouldn't rule it out. And remember also another thing, my analysis showed that when gold starts moving, it takes its time, but it moves. It moves. It's not like Amazon, it's not going to go up 50%. It's not like crypto. It's a real asset. And if it moves, it tends to move. So I wouldn't throw that picture completely out. I still encourage investors to have, especially right now, a portion of their portfolio in gold.
Yeah, you bet. Well, interestingly enough, Roger, I'm not in gold right now because I still can't sort of put my finger on a bottom. And if Senate passes a $1.9 trillion stimulus bill this weekend, which is what is expected, then based on the historical performance of gold relative to stimulus, gold should pop rather soundly quite shortly thereafter. And that's interesting to me. The thing that really frightens me about the interest rates, though, is that there's been no upward motion in the Fed rate. And so for interest, the 10-year to be rising with no correlation to the Fed rate suggests to me that the Fed rate is not broadly accepted as realistic.
Well, it's also not that. It's also Look, first of all, that's the point you're bringing up right now. Jeff Zenaneri and I we talked about this several times. It's definitely widening the curve. It's causing inflation. This is when the short-term rate stays stable, and the Fed, we're not going to raise rates anytime soon. Meanwhile, the 10-year is going crazy. Well, look, home borrowing. Nobody uses the Fed. The Fed. People use the 10-year, 20-year, 30-year, the long bond. So for all intents purposes of real borrowing, consumer borrowing, that short-term rate is not really all that useful. I mean, when you borrow stuff, you don't really borrow it based on the 30-year note. It's just not that viable. So right. Yeah, it's having less of an impact. I mean, if you're a bank, absolutely not. It's having a major impact. But if you're a lender, you're definitely relying a lot more on the long-term view. And look, the bottom line is there interest rate. A lot of people don't understand this, but the better the deal, the Fed wants to raise as much money as possible right now. They need it. They need it. Otherwise, where are they going to get this 1.9 stimulus from? So by giving people a better deal on longer term rates, they're chasing interest, they're chasing bond down and yield up. I can get into this whole economic thing with you, but it's not going to, it's probably going to confuse more readers than it's worth. Yeah. But the point is, I would not discount inflation. Whenever the short-term rate stays stable and the long-term rate rises, that's a very big sign of inflation. And what did the Fed say yesterday? There may be some signs of inflation down the road. I mean, it's obvious. Yeah. It's unquestionable.
Okay. So do you think now is a good time then for our subscribers to be considering moving into some of the travel and sort of world at large stocks, as opposed to, certainly the COVID trade is over for now. I see that, but as Jeff said in the roundtable earlier this week, he said he felt that the move has already happened in a lot of these world in the normal conditions stocks, like travel stocks. Do you think that there's still any juice left in that trade?
I think we have to start treating these stocks not as a group, but as individual stocks. I think that this rally has shown us that it's now fair game. I have a very, very simple requirement. I have to make sure that the stocks that I'm looking at are above the February-March high of last year. The higher, the better. So I want to see as much momentum as possible. My opinion is we can't look at all up till about this point. I've been very critical and very bearish on all of these stocks, and I've been calling them recovery stocks. But they finally are creeping back to the top 10th and 5th percentile of the S&P. I would be a fool to ignore them at this point. But at the same time, what I'm not going to do is I'm not going to put them all in the same basket anymore. I'm not going to put them in the recovery stocks, stay-at-home stocks. I'm going to look at stocks individually right now. It's every man for himself. In other words, if I'm going to look at cruise lines, I'm going to look at every cruise liner differently. I'm going to want to make sure that there's actually numbers behind it. It's not currently estimation. The earnings are heating up like there's no tomorrow expected. I want to see momentum levels rise strongly above where price was last February and March. I want to look at these companies individually. I'm not going to put airlines all in the same group. And I think that's something to what Jeff was actually talking about as well, that there's going to be good airline stocks, there's going to be bad airline stocks, there's going to be good cruise ships, there's going to be bad cruise ships. And I think now is the time to kind of say that. Before, up till now, it was kind of like, don't buy airlines, don't buy cruise ships. But now let's look. Maybe there are some good cruise ships. Maybe there are some good airlines. I think that's how we have to approach it. One candidate at a time.
Yeah, that's very sage advice, Roger, as usual. Let's leave it there for now. A very rousing discussion that you and I could obviously go on for hours about this stuff, but we'll leave it there for now. And I'll look forward to seeing you at the roundtable on Monday. I hope you have a fantastic weekend.
Great discussion. Thanks for having me on, and have a great weekend. Bye, James.